So what that is a very positive indicator that actually this period of weakness in the economy has ended, that we're now at the beginning, we believe, of a re-acceleration phase in the global economy. And that will, in our view, be further supported by very strong fiscal stimulus in many markets around the world. So increasing dividend payouts and buying back shares. It's happening in Japan, it's a real story, and it is driving an investment opportunity. But what I think many investors in the market overlook is actually that story is stronger in Europe.
최근 글로벌 시장이 강한 흐름을 보이고 있습니다. 그러나 일각에서는 고평가 논란도 지속되고 있는 상황인데요. 위기와 기회가 공존하는 시기, 웰링턴 자산운용에서는 글로벌 시장을 어떻게 바라보고 있는지 알아보도록 하겠습니다. 지금 제 앞에는 웰링턴 자산운용의 인베스트먼트 디렉터이신 필립 브룩스님과 김범주 대표님 나와 계신데요. 인사 한번 부탁드리겠습니다.
Good morning, my name is Philip Brooks and I'm an equity strategist and investment director at Wellington Management.
안녕하세요. 웰링턴 자산운용의 김범주입니다.
네, 그러면 매크로 시황 관련해서 먼저 설명 좀 부탁드리겠습니다.
Very good.
네.
Thank you very much. So I'll start on page 2 with the discussion of our view on where we are in the global economic cycle and our outlook going forward from here. There are two lines on this chart. The blue line is an economic indicator that we've developed at Wellington called the Global Cycle Index. The red line is the rolling 12-month performance of global equity markets. Now, the Global Cycle Index is a relatively simple indicator in terms of how to interpret it, but a very powerful indicator in that over time it's got a strong relationship with the performance of global equity markets. You can see in the chart, the embedded data, roughly about a 60% correlation between the direction of the economic indicator and the performance of global markets. Now, how you read the indicator, when that blue line is moving downwards, then global economic growth is slowing. When it's moving upwards, then global economic growth is accelerating. If you look at the far right-hand side of the chart, what you can see is that blue line was moving down until very recently. Roughly the first 6 months of this year, we were in a period where the global economy was slowing. But very recently, in June of this year, that line stabilized, so the growth slowdown ended. In July, data improved, and in August, data improved sharply. So what that is a very positive indicator that actually this period of weakness in the economy has ended, that we're now at the beginning, we believe, of a re-acceleration phase in the global economy. And that will, in our view, be further supported by very strong fiscal stimulus in many markets around the world, but particularly in the US and in Europe. So a relatively optimistic outlook for the global economy from here. We see strength continuing in the rest of this year into 2026, possibly into 2027. That isn't to say that tariffs won't have any impact. So we are in a world where there are greater trade barriers today than for much of the last 80 to 100 years. Now, we know that tariffs do have negative impacts on the economy. So essentially, slower growth, higher inflation. These are valid concerns, but we think they're manageable concerns and will be more than offset by positive fiscal stimulus. So yes, there have been concerns in the recent period about the weaker growth this year, the recent concerns about higher unemployment rates, but overall the economy is in a very robust position. And so the difference between those two lines is essentially the excess level of stimulus in the US economy. We're already there, but as we move into 2026, that stimulus will further increase with the impact of the One Big Beautiful Bill Act. That will be highly stimulative for the US economy and, relatively speaking, should be also supportive for stocks within the US market. So a more optimistic view. So if you look at the far right-hand side chart again, as at today, people have realized that those concerns were misplaced. The probability, the expected probability of recession now in the market is only around 20%. In our view, it's actually much lower than that again. We do not think recession is likely. Now, what this chart shows is trade as a percentage of GDP for every country around the world. On the left-hand side of the chart, you've got countries that are very highly exposed to global trade. On the right-hand side of the chart, countries where trade is a much smaller part of their overall economy. I've highlighted in the yellow line the cutoff point for the lowest 10%. So the 10% of countries around the world that are least reliant on trade. And I've highlighted within there the US market and China. These are both very big economies. As a result of their overall size, in dollar terms, they do trade a lot, but that level of trade is a very small percentage of their total economy. And so people are worried about tariff impacts, and again, rightly so, they will impact some markets more than others, but the impacts on the US and on China, we think, will actually be relatively manageable because trade is a smaller part of the overall economies there. Indeed, I would highlight that the US is the second least trade-driven economy in the world, following only Ethiopia. So one of the key reasons that the US market has done well is for many decades now, it has been a market and economy that has invested more in research and development than most other countries or markets around the world. What this chart shows is dollars spent, US dollars spent on research and development over the last 50 years or so. The US is the dark blue line right at the top. Interestingly too, the light blue line just below it, that's China. So China is rapidly catching up in terms of R&D spend on the US. And so innovation has driven company performance in the US. And indeed, increasingly going forward, we think we'll see similar things in China too. Page 10 looks at the impact that that's had on the US market from a stock market perspective, and then compares the US market to Europe. What these bubbles show is newly formed companies that have become listed in the stock market over the last 50 years in more innovative parts of the market, generally speaking. The green bubbles are the high-tech industries. And you can see a few things here. So overall, the size of the set of bubbles for the US market is much, much larger than the size of the bubbles for Europe. So many more newly formed enterprises in the US than in Europe. And then the overall size of each bubble, there are many more large businesses, companies that have grown value for shareholders in the US than there are in Europe. So that's sort of the impact of innovation at work. It's driven a much wider and deeper investment opportunity set in the US market. Again, supporting the performance of the US stock market over time as that value for shareholders has been created. So going back to right at the start of the 1970s, the US market return is the dark blue line. And that compares to Europe in the light blue and Japan in yellow. So we all know this, but the US market has performed very well. I think it's performed very well in part because of the dynamics that we just spoke about. Greater innovation, greater value creation for shareholders. Now, one other way of looking at that is that performance, this is on page 13, has been driven by better underlying company fundamentals. At the end of the day, companies are driven by their earnings growth. Again, earnings growth is driven by innovation, amongst other things. But here, US earnings growth in the dark blue line versus non-US earnings growth in light blue. Company earnings in the US have for decades been better than company earnings outside the US. And indeed, if we look at the current trend, they're growing faster still today in the US than earnings are growing outside the US. Both are growing, but US earnings continue to grow a little bit faster than non-US earnings today. When we look at a long-term history of the US dollar, again, roughly it's a 50-year look-back period, this is the US dollar index, or the DXY. What we see is the US dollar is about today at its long-term average. So this discussion around, is the dollar overvalued? Well, it's not clear-cut to us looking at the data that is the case. We do know that President Trump in the US would like a weaker US dollar. So, and the reason for that is he believes it would make US companies more globally competitive and therefore be good for US earnings. Trump was successful in engineering a slightly weaker dollar in his first term, and perhaps he'll be successful in continuing to have a slightly weaker dollar in his second term. I think it's a fair expectation. And then when we look at the next two slides, we know that during periods where the US dollar is weaker, non-US markets do tend to improve in their performance. They tend to outperform. We show the same relationship between the US dollar and emerging market outperformance relative to the US, and that's a much stronger relationship. And so if we are in a period where the US dollar is perhaps going to gradually depreciate, then that does create potentially interesting opportunities outside the US. And indeed, we're seeing that in markets today, and I'll talk more about that a little bit later. The other thing to bear in mind about the US is while we are optimistic for the economy and we're optimistic for US company fundamentals continuing to do well, the US is simply a more expensive market than most other markets around the world, and that's what the chart on page 22 shows. And so when we look at valuations, company valuations in non-US markets, so whether that's Europe or Japan or here in Asia, they are generally more attractive. And so increasingly we are seeing investment opportunities outside the US too. Now, maybe to give some context to that, we do not think that the US market is likely to do poorly in total return terms, but we've been in an environment for 15 years now where the US market did much better than everything non-US. Perhaps that's now starting to change, and performance outside the US is going to improve. The level of improvement has been faster outside the US this year than in the US. Again, speaking to potentially a new set of opportunities starting to build in non-US markets. And Europe, I think, is an area that is very interesting in that context today. And then driving the opportunity set in Europe, I mentioned earlier strong fiscal support in the US, but also strong fiscal support in Europe. What we are seeing in Europe, really, I think in large part driven by US policy actually, but is a significant commitment to increase spending levels on defense. And that's what I'm highlighting here in the chart on the right-hand side in the green box. Current levels of defense spending as a percentage of GDP versus the new, much higher commitment. And while it's sort of notionally called a defense spending program, actually it's far wider than that. So it's not just in defense companies, but it's more broadly an infrastructure program of spending that will reach across many industries in Europe. So quite wide effects for the European economy. And that should continue to support European growth. European growth is already improving, but this stimulus we think will be very meaningful in further increasing growth levels in Europe, which should be good for European companies. And they're very inexpensive. So there's a very interesting opportunity in European equity today. There has been quite a lot of interest in the Japanese stock market by foreign investors in recent years. And one of the drivers of that is that the corporate reforms we're seeing in Japan are resulting in greater levels of business efficiency and greater levels of capital return to shareholders. So increasing dividend payouts and buying back shares. It's happening in Japan, it's a real story, and it is driving an investment opportunity. But what I think many investors in the market overlook is actually that story is stronger in Europe. That's what this chart shows, that capital return to shareholders in Europe, that's the dark blue line, is actually higher and has improved faster in the recent years than capital return in Japan. On a relative basis, Europe has been overlooked. And so I do think that it's important to focus in opportunities in both of those markets. And indeed, over time, because Europe has been better at returning capital to shareholders than Japan for some period now, the European stock market has also outperformed the Japanese stock market. Will that trend continue? It might do, but again, we do see opportunities in Japan as well, and that's what I highlight on page 27. And so this is the reform story in action. The chart on the left-hand side shows the number of activist proposals by shareholders seeking to drive improvements in company efficiency and improvements in capital return to shareholders. You see that very significant trend over the last 10 years. And that will continue in our view. And it has the opportunity to continue because of the structure of the Japanese stock market. What the chart on the right hand shows is the percentage of companies in each of these regions that have most of their revenues coming from one line of business. versus the other structure is conglomerates, companies that have exposure in many different underlying businesses. Japan has more conglomerates and fewer focused single line of operation businesses than any other region. And I generalize, but generally speaking, those conglomerate businesses aren't as good at capital efficiency and capital return as single line businesses are. And so that opportunity set for reforms to continue in Japan is a very large opportunity set. And from an investment perspective, we are finding some interesting ideas there as well. Thank you very much.